All right. In chapter 4 of of your intermediate textbook, we have a chapter entitled "The Income Statement, Comprehensive Income, and Statement of Cash Flows." And so, what we want to do here is talk. We're going to step up the income statement from what you've done in the Principles 2301 class. And so, in that class, we did what's called, and you did it on your most recent exam, is known as a single step income statement, where you listed your revenues and then you listed your expenses, and that came to net income. And so that's a fine way of doing it for a very simple company, a small company, where everything is very controllable. But as you get larger and larger, and as things go on with a company, we go to a multi-step income statement. And we're going to add several different sections, kind of some section breaks between the revenues and the net income number on that, and in order to do this. And so the first thing that we're going to do is we're going to create a gross profit. So we'll take the revenue just like we always did, but now we will subtract the cost of goods sold, and that will give us a gross profit number. Now, the gross profit number is very important because now this is a little bit simplistic, but it tells you if you are selling for enough, if you're selling for enough money. Every industry has its own metrics as to what is appropriate in that industry. If you're in a grocery store, for example, they have a lot of turnover, they generate a lot of business every day, and so they would have a lower gross profit. On the other hand, something that sells very few items, say Tiffany glass or something like a Cray computer, which might sell one or two a year, in that case, you're going to want your gross profit to be much higher. And then you take that gross profit number and divide it by the revenue number, the sales number, and that gives you the gross profit percentage. Gross profit percentage tells you a lot. But like I said, each industry has its own separate metrics of what is appropriate. So like again, a grocery store wouldn't be appropriate for an oil field firm, which wouldn't be appropriate for a retailer like Best Buy, for example. And so you have to know what industry you're in to do that. Okay, so after you get the gross profit number, then comes what we call your operating expenses. These are the things that you have in the normal course of business. It's what you normally think of. So it's going to be things like your administrative overhead, the cost of your offices, your shipping expenses, your marketing expenses, your advertising expenses, all those things that relate to the core business. And they all add up, and you take that set of expenses and subtract it from your gross profit number, and that will be your operating income before interest and taxes. Now that's important. That's an important number, and we separate it out before interest and taxes for two reasons. First of all, how a business is structured is very individual, very unique between companies. So some companies will use a lot of debt, very little capital, and when things go good, that's great. It gives the owners more income. On the other hand, when things aren't so great, there's greater losses for the owners, and that's known as leverage. So we don't include the interest expense, and we don't include the taxes. That'll be the net operating before interest and taxes, EBIT, earnings before interest and taxes. Then you subtract out your interest expense, and you subtract out your tax expense, and that will give you your net operating income. Now, net operating income becomes important to a company because this is the core of your business. This is what is repeatable year after year after year. This isn't things like winning a lawsuit, unless you're a law firm, of course, but this isn't winning a lawsuit or or the expenses on the other side. And as you'll see in just a second, we'll have a separate area for discontinued operations. And so this net income from operations is important because that's what's repeatable. Now, obviously, the economy will go up, the economy will go down. Your own sales processes will flounder or flourish, but that net operating income is what's generally considered the core of the business. After the net operating income, then you will take the discontinued operations. Now, let's talk about discontinued operations for just a second. When we do operations that are being discontinued, it can either be a segment of the company. For example, we're seeing out here in West Texas a lot of the integrated major oil firms getting out of the exploration and production business and focusing on midstream and the refining business a little bit more, chemical business a little bit more. And so they're discontinuing their E&P, exploration and production activities out here. Those would be discontinued operations. Discontinued operations can either be a segment of a business, or it can be a geographical segment of a business. And so we sold off all the business east of the Mississippi River, for example. That would be discontinued operations on a geographic basis. And these things happen. They're pretty common in the ordinary course of business. If you stick around the business world for 10 or so years, you will see all of these different things happen multiple times. People get into business, people get out of business. Another thing that can happen is a restructuring charge. These are unusual ideas, but that doesn't go under discontinued operations. That's still in the core business, those sorts of things. So anyway, then we get the discontinued operations. Now, what's interesting on the discontinued operations is we take the income tax effect into account when we report it. And so if we made money on the discontinued operations, we'll have to pay tax. And if we lost money, then we will get what's called a tax benefit. We'll get to reduce our other taxes. But the net income from discontinued operations, or net loss from discontinued operations, is reported net of the income tax effects. And that's an important thing to remember. Notice that we did report the income from operations and then what the tax was. But on discontinued operations, we take the tax effect into account when we report the income or loss from discontinued operations. After that, you will get a net income number. Now, net income is a very important number, of course, to investors. You might hear somebody say, I'm a bottom line kind of person, and that's what they're talking about. They're looking strictly at the net income. There are those who argue with legitimacy that the net income number encompasses everything that a firm is doing, and so that is the most important number. On the other hand, you have other analysts who believe that the intermediate numbers, such as the gross profit percentage, sales revenue, the increase or decrease in sales revenue, those are also important numbers. So it just depends on what you're looking at in a firm, what you're trying to see. Okay, so after that, we're going to get into something new that was not talked about in your 2301 class, and that is comprehensive income. Comprehensive income takes the net income number and then adds or subtracts some other numbers to it. These are often numbers for which we have some type of responsibility, but we don't have absolute control over. For example, a pension plan might be that. If we have what's known as a defined benefit pension plan, we are responsible for seeing that our workers or former workers receive their benefits. And so if the pension plan suffers a loss, It's not part of our core operations, but we do have a responsibility to see that that income is made up so that the beneficiaries of that pension plan are made whole. We have a whole chapter in Intermediate 2 on pension plan, and really, to be honest, that's just touching the tip of the iceberg on pension plans. They're very intricate, they're very involved, but that's one of the things. Another thing that we might have in comprehensive income is the gain or loss on securities we hold in other companies, but we don't report on the income number. So we haven't sold the investment yet, and so we have to say, well, we kind of made this money or we lost this money on some investments that we made, and that would be reported in comprehensive income. So on the income statement, you have a comprehensive income, and on the balance sheet, you have accumulated other comprehensive income. So both of those are new to intermediate accounting, and you'll need to get a handle on those. You won't have to calculate comprehensive income yet. Right now, it is just a knowledge of what the concept is, that it's something that we're responsible for but don't necessarily control, or something that has not been completed yet that we're marking to market, and we're telling investors where we actually stand on that. All right, the next thing that comes up in this chapter is the statement of cash flows. Now, the statement of cash flows is a very important statement. All four statements are important. Some people like to look at this statement as probably the most important statement. The statement of cash flows is most like your checking account. It's what actually happened to cash during this period, usually a year, can be for a quarter, usually for a year. And so we look at the statement of cash flows, and it's broken into three sections: the operating section, the investing section, and the financing section. Now, the operating section, and we will get into this a little more. It's the last chapter of Intermediate Accounting 2, the Statement of Cash Flows Revisited. We'll get into this a lot more detail next semester when we get into the Statement of Cash Flows. But the operating income section can be performed, can be calculated either the direct method or the indirect method. It really doesn't matter. You'll come up with the same answer if you do it correctly, regardless of which method that you use. FASB has stated that their preference is to use the direct method. It turns out that about 94% of companies listed on Wall Street use the indirect method. So even though FASB, says they have a preference, that it's more likely that they will use the indirect method. It doesn't really matter, because in the footnotes you have to include, of the financial statements, you have to include enough information that the knowledgeable user of the financial statements could, if they want, construct the operating section of the cash flow statement by either method, indirect or direct method. So the information will be there in order to do that. The other two sections, regardless of whether we use the indirect or direct method for the operating section, are both done using the direct method. The investing section, the thing that you need to be aware of is that investing in common parlance, if you will, has two meanings. One would be the investment like we think of as a finance major would think of investment. So we invest in somebody's stock, or we invest in somebody's bonds. And those are it can't be our own, it has to be somebody else. But if we do invest in somebody else's securities, those are certainly investments, and we account for them here in the investing section. But the other terminology that is used is the economic terminology of investments. And to an economist, if you buy property, plant, and equipment, that's considered an investment. And you'll hear you'll hear people talk about, we invested in a new building, we invested in brand new machinery, or new delivery trucks, or green green fleet of delivery vehicles, or whatever it might be, that we have invested in this. And those are legitimate investments, but it's more the economic context of the word rather than the financial context of the word. Both of them are covered in the investing section. So when we buy an investment, that is a use of funds, and you often see negative numbers in the investing section. That means that we're adding to our investments. For a company that's growing very rapidly, they're obviously buying new equipment, buying new machinery, buying new storefronts, all that sort of thing. So they're doing a lot of investing. So they will have negative cash flow from investing. On the other hand, if you're selling a lot of things, and companies who go out of business often sell a lot of their things, so they'll get a lot of investment, or get a lot of cash from their investing activity. So you need to know where a company is on its life cycle in order to understand what the meaning is as far as the investing section of the cash flow statement. The final section, the third section, is the financing section. And this is basically how we gain our capital to operate. And there's basically two ways of doing it. We issue stock. That can be either common stock or preferred stock. We issue some type of stock, some type of ownership rights in the company. And so that would be a financing section. Or we go out and borrow money. And that is also finance. So we borrow from a bank on a one-year note. That would be financing. We borrow from investors in a bond that we issue bonds to them for maybe 30 years, and that is also financing. And so a lot of times growing companies will have a lot of cash inflows from financing activities. Now, on the statement of cash flows, a couple of anomalies occur that you need to be aware of. And it's a little bit, in my mind anyway, it's a little bit incongruent. So on the investing activity, if we pay a dividend to shareholders, that's considered an investing activity. But if we pay interest on those loans that we have from financing, that's considered an operating activity. And so that's something that you need to keep in mind. Paying interest is an operating activity versus paying dividends, which is a financing activity. That's about the only anomaly I know. So you can look at the cash flow, and what you should be able to do is look on the balance sheet at last year's cash and this year's cash, and then look at the cash flow statement for the year, for this year, and you should be able to explain that difference in cash between last year's balance and this year's balance on the balance sheet. And so that's what the cash flow statement does. Now, one of the things to remember in the one of the earlier chapters, I mentioned that if we are given the fact that the financial statements are done honestly, that they're not trying to create fraud or something like that it's very hard to fool investors, knowledgeable investors, if they read all the financial statements. And so that's where you can see where companies are trying to fudge numbers a little bit, if you will. So what you'll see is on a cash flow statement is accounts receivable go up. That means that can mean if there's not a corresponding increase in sales, what that probably means is they are selling to less on credit to less qualified customers, and they're not writing off those loans, or that they're those receivables as that maybe they should be. And in the notes in the financial statement, there should be an aging of cash of receivables. And so you should be able to see that. That's one of the things that you can spot very early. If you see a company selling off, their cash balance sheet looks really good, but they're selling off a lot of their investments. And a lot of companies will do that. What they will do is they will do a sale and a lease back. So I own a building that's worth $10 million. I sell it, and then I lease it back for $150,000 a year. And so I get this cash inflow of $10 million, but now my expenses have gone up. And you see that a lot of times in companies that are struggling to raise cash. And so the statement of cash flows is a very important statement when we're looking at things. It tells you a lot about a company. Cash from you want to see cash from operations always being strong. The only time that's not true is when you've got a really rapidly growing company and their interest expenses, because they've had to borrow money to build stuff, but their interest expenses are there, but their assets haven't caught up yet and started generating operating income. So they may have a large interest expense in the operating section. That's one of the things that you want to look at. But other than that, cash flow statement is pretty straightforward, and it is a very important thing to use on that. The difference between GAAP and IFRS is really pretty narrow. If you understand GAAP, it's easy to transfer over to IFRS. There's a few things that happen when we talk about inventory in the U.S. We have to write down inventory if it becomes less valuable. In IFRS, they can write it down, but then if it goes back up in value, they can write it back up. Once we write it down in the U.S., we have to keep it at the lower level. That's one of the things that is distinct. In the U.S., for example, if we have a outcome on selling something that is a probabilistic thing, in other words, we've got a 60% chance of getting $4 million from this sale and a 40% chance of getting $2 million on this sale. In the U.S., we choose the most likely. So we would choose the 60% of getting $4 million. And under IFRS, they would weight that. So they would say 60% times 4 million is 2.4. 40% times 2 million would be 800,000. So they would add the 800,000 to the 2.4 million, and they would report it at 3.2 million on that. So they use a weighted average on probabilistic income amounts. And there are sales that can occur. We'll talk about this in the revenue recognition chapter. There are sales that can occur that the price is not determined yet. It'll be determined by some other factor later on. But the sale is essentially complete, and we can make a reasonable estimate, so we include it at that time. Okay. There's also a number of ratios in this chapter. I don't get real heavy into the ratios. You probably notice that. I believe that's more the area of your finance class, and we offer a class on financial statement analysis that I think is a great class. All accountants should probably take it at some point. But that's where you're going to get more into the ratios. Obviously, there's a few that we'll talk about, such as debt to equity on the balance sheet, percent sales, those sorts of things that are important. And so anyway, so that's just a brief overview of Chapter 4 and what's going on there. And I intend in the next 3 days or so, today is Wednesday, next 3 days, to be writing some problems. So you'll have some examples of what we're looking at in this chapter. So until then, we will talk to you later, and good luck with everything.